The views expressed in this video presentation are my explanations and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I am Dollar Will. Let's get this money. Let's see. We're going to talk a little bit of US dollar because the dollar is running the show. You can look back at my channel from the past, going back to the beginning, 2017. I've been on this watch all that time. That's why I'm Dollar Will. The US dollar is the default currency of the world. It's linked with the interest rate. After all, the interest rate is the price of money, the price to borrow money. And low interest rate helps business grow because they use their credit card, just like you use your credit card. So we were in a cycle where credit was king. You use your credit card, you borrow money, you buy resources, you process them, into products that you buy in the store, up to and including your house. Okay. But then when that growth, so that's the growth cycle. When that's over, you go back to a cash cycle. So we're going from credit being king and the saying cash is trash to now cash is king again. And we could be in this cycle for a while, for several years to come. The U.S., despite all of the disrespect that the U.S. dollar gets, the low in the U.S. dollar was in 2011. We are approaching 2023. So you would think that the dollar would be falling off the face of the of the earth, the way people talk about it. That's how I know that people don't look at charts. For all that they talk about, it's a lot of emotion about it, as opposed to some real science and math, okay, logic and reason, right? And so what we're looking at here today is one way to look at the dollar is in the Forex market. And I like to look at it that way. There are ETF symbols you can buy the US dollar straight out. And the most popular one is the Dixie D. That's DXY. And there's another one, UUP, up. Okay. And that's if you just want to make some money on the direction of the dollar. And so the dollar going up is it signaled that the market was going to turn, that the S&P was going to end up going in reverse. They don't move lockstep, so the dollar can change direction for a period. It'll take some time for it to ripple, for the impact of the dollar to ripple throughout the economy and slow down the like the uptrend in the S&P. So it's not like a one for one, like if the dollar changes direction today, everything changes direction. It sort of happens in stages. Like, so the dollar is first, if you look at it on the charts, well, over time you'll see me you'll get it all together. That's why all the pieces will come together. After why you have to stay tuned here. Like I said, the low for the dollar was in 2011. And it really is the dollar that leads everything, because the dollar bottomed before the interest rates down cycle bottom. So first the dollar, but there's a relationship between the dollar and the interest rate, which affects the price of gold and oil and all of the materials all the stuff we take out the earth, that we process into goods and products. Okay, including like your cell phone. So if you look at the items that we use and think of them in terms of their chemical and metal and element, the element, what it is materially, originally, organically, um, it traces back to something in the earth. you know a lot of it comes from Africa. Not to go there, but but that's when we can take it. It can go that far. And all of those assets, generally speaking, trade opposite the dollar. So the dollar rising has a negative impact on the price of, eventually, ultimately, uh, on the price of everything, but more specifically, metals and, um, I don't want to say everything. I mean, that's too far. It has a negative correlation with energy and metals, and much of what we use to build this industrialized world goes back to metals and energy. You know that from your utility bills. Okay, all right. So what we got on screen here? What's happening on Unreasonable Man? I'm gonna speed through this because I want to come back and I'm gonna do a whole nother video about. Like, I think I'm gonna do two more today. One about the S&P, then another one on Ethereum, Bitcoin. Okay, so it's gonna be a busy day after me not, putting up much. So y'all see, I don't post every day. So if you like this, you're gonna have to share this. I need to see that subscriber count rise to make me really get motivated to post here every day. Most of my work is on my Patreon, so they hear from me a lot. Okay, so I'm way more active there. You know, it's a small group, but hey, they support it. So that's where I am. All right, so we got this. I'm not trying to get. I'm an Elliott wave theory trader. Okay, and included in that, or in Elliott wave theory, embraces like price action, support and resistance, all that other stuff that you see a lot of other technical traders discussing on YouTube. All that stuff is baked in to Elliott wave theory, plus a whole lot more. Okay, plus a whole lot more. So I go into the details of that on the Patreon, and I can provide private training and group training on that. All right, so we have a. I'm not to get too much into the structure. I discuss it on Patreon, but after this move, which is a common move within Elliott wave theory, common is a shape to this it's a pattern um, that we look for. People are creatures of habit. Um, we're sort of like ants in the sense that there's a group behavior that's just common for humans, and you can see that pack behavior in our collective actions in the stock market. The way that we buy and consume goods and services and products, materials. It shows up in stock charts, and at the base of there's a sociological component of Elliott wave theory. So it's like the intersection of Elliott wave theory is like this intersection of sociology, economics, geometry. Yeah, that's about it. That's a lot, and demographics. I guess sociology kind of covers that. So it's a lot. So a lot of things will come together No matter how from what direction you see things, you come to Elliott wave theory. It'll lock in a lot of things. You'll get a good understanding of how the dominoes fall. Because, like I said, you can go on my channel and look back in the past and see I've been making projections. Now, there are many flavors of technical analysis. Elliott wave theory is just one. Technical analysis is not um, perfect, meaning we can't tell you the exact price, okay, that something's going to head to. We can tell you a general area, okay. We can so that's mostly what I do as a practicing market technician and trainer of other technicians. We point out areas. Now, the price could take a while to get to those areas. It depends on the rate of acceleration and deceleration, or how long it spends going sideways. We call these consolidations. So we don't exactly know when it's going to get there, but we have a general idea of where those key areas are, where the price, those reflection points, where the price is likely to have trouble exceeding. We call that resistance, okay? And so that's what we discuss. And so being able to point out these areas allows us to know, or make good judgments based on something beyond our emotions about when to take the money out, you know, to avoid retraces like this. This move right here, like I said earlier, this is a common, oh, this thing is common Elliott wave. Let me see. I'm gonna save this and reload this thing, because that's the only way you get this crap off. You see all my Ethereum charts in here, so y'all see I'm getting busy with Ethereum. Um, this is a common Elliott wave structure, and what and we know per the pattern of behavior of prices going back, we can go back 100 years or more and see these reactions to prices. It's like I said, it's something in the pack behavior of people, collective behavior of people. And this Ralph Nelson Elliott is the person who, I guess, the founder of Elliott wave theory, and he discovered this back in the 30s. Okay, so we didn't have computers, we didn't have personal computers back then, and he was studying this behavior in price action. And even when the 80s came and we got personal computers and we were able to bring up charts like this, that behavior persists. So when we were not knowledge of the repetition of these patterns, it was happening. And even when we became knowledgeable of it, it still happens. So go check out that first video on my channel from 2017, where I, I show key moments in history like World War I and II, World Trade Center. And you can see that basically I debunked the myth that news and events dictate price action. Now, from an emotional, seemingly logical, rational basis, you would think that's true until you learn something like Elliott wave theory and you test that assumption that news and events cause prices to ricochet back and forth. That's just a lie. I'm not gonna say it's a lie. A lie would mean that they know that what they're saying isn't true. I'm gonna say it's just false. It's just false. It's the news correlates with, there's a correlation, but correlation is not causation. Okay. All right. So I will challenge you, dare you to watch that video and watch what other market technicians, especially people say in the Elliott wave theory camp or the Wyckoff camp or the harmonic pattern camp, all of those schools of thought under technical analysis they have, we don't like to say this as it kind of backs us up into a corner. It has predictive, how do I want to say this? It has predictive value. Let me say it that way. All right. And until you learn it or try to learn it and observe it over a period of time, you won't understand it because you won't. It sounds incredible until you see it, until you really look at it. It's like okay, but then you think about it, and it's not so incredible. Okay, because the price of goods and services, that's a pretty good reason why we war. So I maintain that the Federal Reserve and policy, economic policy, and all that, monetary policy, that stuff doesn't create the moves in the stock market. The moves in the stock market is creating the policy. They're responding to what's going on in the environment, and the environment is the trend state of these prices. Okay, uh, the price of your house, the capacity, the ability of your income to keep pace with inflation. The policy is in response to our hoarding and consumption of key assets, key materials like gold and other items or copper more specifically. That's even better than gold. Um, I really didn't intend to do a rant on this or get into a long thing on this. I just wanted to talk about the chart. But basically, what I'm trying to say is that um, everything is subject to supply and demand, including the stocks themselves. So when there's a commodity, metal, or energy, or something that's going up in price, people hoard it. They buy lots of it in anticipation of it being more valuable in the future, and they sell it later at a higher price. Buy low, sell high, and that hoarding behavior causes the price to go up. And this happens over decades, not day to day, week to week, year to year. It happens over time frames longer than a presidential election or a term of office. So the president inherits the condition. So that's why the president can't really make radical change, um, not often, especially with things economically related, because it gets into trade agreements between countries that span decades. Countries, when they make agreements to sell excess of some commodity that they have, those agreements are longer than the term of a president. Okay, and so once it's like a dog whistle, everybody knows. Okay, so we have this agreement to sell, um, to trade food for oil or whatever, or whatever. One country has an excess of one thing, and another one has an undersupply of that same thing. So that sets up the basis for trade, and so others know. Okay, that's a guaranteed trade. So people hoard it, get in on the trade. Okay, but there you go. So this is what we got with the dollar, a typical 50% retrace, and we go higher. But let me show you on a bigger scale, on a monthly. This is what I said. We had a huge, the dollar has been trending down. That's the normal trend state on the dollar. It's not broken. That's what it's supposed to do. This is back in the 70s. So when the dollar goes down, the value of the materials goes up, and your house is the biggest symbol or collection or repository of those materials. You have metal, many types of metals in your house. Um, Copper is a big one, and steel is a big one. Okay, You got aluminum is a big one with your appliances and stuff. And so the dollar going down, it's like a seesaw. On one side of the seesaw, we have the dollar. On the other side of the seesaw, we have the metals and energy. Okay, precious metals. Some of them are precious metals. So when the dollar goes down, those things go up, and that's why we are told to buy a house, because that's how we protect the value of our dollar, is by buying a house. Now that works in general. That's the basic theme over long stretches of time. However, there are exceptions to the rule. Okay, there are exceptions where the dollar rises. The normal trend state for the dollar is to go down, okay, which makes everything else go up. Anyway. So we see this from 1978 to 1984. That was 6 years. So when the dollar does these counter trend moves, it can last a while. Okay. It's just that in this particular case, this low here was in 2011. And so these counter trend moves we call corrections. And the dollar correction here that we're in here um, is a correction of this bigger move from 1971 or late 60s. I think it actually goes a little further back, but they don't show us all the data here on Yahoo. It goes back a little bit into the late 60s. And you'd have to, get into Elliott wave theory. Like I said, you can join my Patreon. I can tell you, when we're talking about a minor correction like this versus a correction of this bigger cycle. So, and then there's what I refer to over here as the hell trade. There's a camp that argues that we're really in a bigger correction, an even bigger correction. You can look up grand super cycle correction, bigger correction of a trend that began after the Great Depression. If you look at again some of those early, like the first video I had on the channel, I go back to 1932 and talk about from there to now. The price chart looks like Superman. Well, we know everything that goes up has to come down. We don't mean it does. We're not talking about coming down to where it started, but it has to have some type of pullback. The prices oscillate. It's like waves. That's what Elliott wave theory. It's like waves. So there's a correction, a pullback, a reversion to the mean. You hear that term too. And the bigger cycle that everyone is concerned about is that cycle that's about 90 years long. That's why you'll hear me say no one alive has been through anything like the correction that we're already in. Okay. So the high in January in this year in the stock market, I believe we won't see that price level again. It could be a long time. It could be a decade or more. Okay. Before we ever get back up there. So a lot of people are told buy and hold, buy on a dip and all that. Remember this, 6 months from now. All right. Because all of that's crap. All that, this is my opinion. I'm not a financial advisor. Okay. I'm just a practitioner of technical analysis and the Elliott wave theory, and we don't believe in buy and hold. Okay. The trend is your friend, but you have to learn the trend before it can be of any value to you. Okay, so we have a correction here, and in the near term, in my view, we're headed up to this level. We're gonna snake our way, meaning we're not going to go straight there. We're going to zigzag, oscillate, okay, up to this price area that we were in 2008. Okay. And then we should have a substantial pullback, but not now. Once we get up to this area, then we'll see. Then we'll see whether we're talking about a smaller correction of, say, just this move here from year 2000, okay, the Y2K uh, concern, when we thought the world was going to end because the computers weren't programmed for the digit, to go to 2000, and we every all the doomsdayers were out, and Prince came out with 1999, so we were in fear, okay, mortal panic, all right. um and this was also the dot-com uh, bubble. So the .com, so all the computers and IT stuff, uh, uh, electronic stuff, hit a price high. So no, that's really it was the internet. It was basically the internet. And so everything, the way now everybody's putting blockchain in their name, everybody's putting .com in their name. Okay, and then the dollar fell. And so there's a need for this long decline from 2000 to 2011, 11-year decline in the dollar. It's natural and necessary for the dollar to recapture some of that loss. And Elliott Wade guides me to believe that this is where we're headed. Now, once we get there, the price can either, this is where it's going to get tricky once we get there, but we're getting there. And I was saying way back, and like I said, when I first put a video up on 2017, you can go back and look at it. We're going to get up here. Now, the scary part is, will the dollar continue to fall after we get there and make a new low? And then if that happens, then the stock market will go higher, and we'll just party on like we've been doing? Or are we talking about a correction to a bigger trend, in which case the dollar will, once it gets here, it'll retrace 50%, just like it did here. Just like it did, I'm sorry, on the daily chart I had it. Yeah, we'll see when we go back there. So will it retrace halfway, say maybe about to here, and then continue rising? If that happens, then it's hell. Then we are talking about a correction to that trend from 1932. So we're looking at that as a distinct, highly probable event. Okay, so, and what does that mean to you? It would mean, first of all, forget house flipping. All of this is my opinion. Okay, that trend is over. It's over. You're not going to make any money flipping houses. The value you see in your house, your equity position that you've fallen in love with, is going to be destroyed. Your retirement account, if you can, the people, this is just my opinion, please consult your financial advisor. I am not a financial advisor. Talk to your financial advisor. But a rising dollar suggests that the interest rate will continue to rise as well. If the interest rate continues to rise, businesses can't continue to grow because they can't borrow money. People won't buy houses because they're unaffordable, because the price to borrow money to get a mortgage is too high. And so if people aren't getting jobs, when in fact they're getting laid off instead, because the companies have to pay interest. That rising interest rate increases the payment that the companies make to the debt that they're carrying on the books from the credit cycle. So companies are more concerned with getting rid of that debt that's choking them out month to month than hiring new people or keeping people. They're more likely to cut and ask you to work twice as hard for the people that are lucky enough to stay. So the dollar rising again means that now in the global sense, the globe is in crisis. And so when the globe is in crisis like that, other weaker countries, they don't trust their own currency. So they sell their own money and trade it and buy what? The US dollar. Because America's, if you really want to boil it down, we got the biggest, we got, strong military. So, and America's population is the largest and richest. Okay, and so America can raise taxes on its citizens to pay any debt. So, uh, major countries around the world generally will trade their currency and buy stack up on US dollars. It's a good investment because it continues to rise. Like anything else that continues to rise, people hoard it when it's in demand. So um, the dollar being in demand by other central banks around the world, that's also pushing the price up. All right. So it would have a negative impact on growth. Um, it will have a negative impact on hiring. It will have a negative impact on, and both of those things, loss of jobs, um, decimation of people's retirement accounts, equity in their homes that makes people more afraid, and so they don't feel like making a long term commitment like buying a house. And so it's going to change a lot. But what we got here in the near term is as part of this trek higher, um, the dollar has a minor move down coming, and we'll see if this low holds. But I think it's minor down, and then we go higher, continue this trend up towards. The first thing everybody's looking at is this. The most important price area with the dollar is this. This this area here, this close back in 2015, and this in here 2019. I can go to candles, and this is the close view, and this is the peak was actually in 2016, but the high close. So this area here, um, and we didn't get there here, and then but if in this next push up, we're going to exceed this, and that's going to freak the world out because everyone was celebrating when the dollar started falling and making these lower lows because the hope, the prayer was that we would take this out. But if instead we take out this high, then that causes everyone to accept the fact that the dollar is trending up and that this high was not the end of the stress, okay? Because the dollar rising is a bad thing. So there was celebration that it was going to go lower, and so if this and we got this oscillator here, so when it comes back down, this low can't go away. But I don't think we're going to come anywhere near it. I think we're going to keep going up after a minor pullback, keep going up. But it's something to watch, and you'll see the interest rate continue to go up. And one thing in particular that's affected is gold. Let's look at gold. Remember, they have an inverse relationship. Okay. And so this is a familiar Elliott wave theory pattern. And once that pattern completes, the price retraces um, generally a minimum of 50%. So either from half of the loss to three-quarters of the loss in the ricochet back. It, it's you recover or recapture anywhere from a half to three quarters of the loss. Okay, from 50 to 75%. Think of it that way. All right, but I think we're gonna end right around this area, and then the gold is gonna fall off the map. So that's going to um shake up a lot of people, because a lot of folks mistakenly believe that gold is safe always, but gold is perennially safe. Now, historically, generally, it is, but not always. Remember, this is opposite the dollar. So remember, the dollar chart was high up here, and this is gold low down here in 1970, 71, and the dollar was tanking, while gold was rising. Okay. But gold, if the dollar rises, that could stress gold and cause gold to tank. So I think gold is going to come below this. Okay, so remember, we were looking at that high around 2015 or 2016 for the dollar. Well, that corresponded with the low in gold. So when the dollar was falling, that allowed gold to rise. But now the dollar is rising again. Duh, that means gold should fall. Okay, the same with oil. Right. And so while we're looking at Bitcoin, nothing wrong with Bitcoin. My only issue is people that say that there's no other opportunity out there but Bitcoin. That's crazy. That's someone that just started trading about 15 minutes ago. Okay. Because that's all we do in these markets is make bubbles, make and burst bubbles. That's it. There's never been a time when there wasn't something like near Bitcoin level. It's always happening. That's just what we do. We hoard. Something becomes fashionable to do, or affordable, fashionable and affordable. Okay, when fashionable meets affordability, okay, you get a bubble, and the bubble bursts. And as technical traders, we're trying to identify these trends and get on them once they start, and leave, at 1 o'clock in the morning. We want to leave before they turn the party out, before the fight comes. All right, that's it. All right, so that's what's going on. So gold is likely to come back up to this area where the price fell, and then die. All right. So this trade looks pretty good. Um, who knows how long this will take? It's a daily chart. This could take. Let's see how long this took. This took from July the 21st to August the 10th. So what would that be? 2 weeks, 2.5. So I think something like that. So that would get us right past Labor Day. Okay. So yeah, we get past Labor Day, we'll see where we are. And so right when it's time for school shopping, right, uh, the dollar should really take off again. Wow, so that would mean, so when the dollar takes off, we're going to have some serious price destruction. For the people that have money and are in a buying mood, it's going to be some awesome sales going into Christmas. It's going to be some, get ready to do some serious clearance shopping. It's going to be some awesome sales, because companies, I'm just thinking of this, companies they bought a lot of those, they use credit to create those, to buy those products, and stock their shelves with that inventory, and the interest rate is going higher and higher. It's killing them. So they need to get rid of those daggone items that they bought at as that interest rate is going up, to get rid of that debt. So we're going to see some. So for those of you who like to shop, you're going to see some awesome deals like you've never seen in your life. They're going to be giving that stuff away. Wow. If you're of a certain age, say close to 60, I'm 58, you remember a thing called a rain check. I haven't heard of that in a long time. When you go in a store and they say, well, we don't have that item in stock, where you take a rain check. Well, when times get tight like this, companies can't afford to have that stuff in the store. Well, this was back in before we had the internet, so we'll see how it goes now. But in the days before the internet, they would give you a rain check, and so everything was, you kind of think of it as made to order, because companies didn't want to like pre-produce a whole lot of stuff and then have it sit and have the interest rate go higher and higher, and they lose money while the thing is just sitting on the shelf. So we're gonna go back to get used to the companies not having stuff, or even online. It might take a little longer to for it to be delivered, you know, because they may not be making a whole lot of them in advance. Right? So yeah, so that's what's going on with gold. Because we should have a nice run, at least for a couple of weeks, and then have a nasty decline. And if the script goes as it, I don't want to say should. I don't like saying should with the market. Um, I would say sync. If it syncs up with our behavior, we could have a rough go from Labor Day. It could be very ugly in these markets from Labor Day through Black Friday, or just past Thanksgiving. And I can see us hitting a bottom. I don't want to say the word bottom, because we could be doing this for a while, up and down the cycle. If this is the hell trade, let me just say the bottom of this particular wave, past Thanksgiving, and then trend on, let me say, retrace. I don't want to make people think, oh, it's over. Then retrace through Christmas. Interesting. So this is going to be a very interesting next or last quarter of the year. So that's what's going on with gold. So how do you make money off of this gold thing? The gold bust. Be careful. This is going to be the ugliest chart you've ever seen. All right, before I go to it, again, keep in mind what you just saw. I'm going to go in logarithmic mode. This is what gold looked like from 1970 in log mode, okay? So I'm going to show you what it looks like to bet against gold. It's going to be ugly. Okay. This is what what it looks like since 2013, betting against gold, just since 2013. I'm going to go in log mode. So what this particular um, symbol does is it's a reverse. It's a gold miners index. It's a bear index. It's leveraged 2 times. So that means this thing rises twice the amount that the gold miner stocks fall. Okay. So it's a way to it's a way to make money on a decline, but it's extremely dangerous. I'm just saying, talking about this just for entertainment and educational purposes. I'm not encouraging anybody to buy anything. I am not a financial advisor, but this is for the brave, folks that know technical analysis, because you have to watch this sucker. It doesn't always do as advertised. It's advertised to rise when gold falls, but it's got it correlates with that. But directly, more directly, what it is looking at the futures market, and say you can also get a sense of it from looking at the options market. It's the it shows the demand for, let's say, puts in the options market, but more specifically, shorts, bets against gold miners, in or bets against gold, if you can look at it that way too, in the futures market. So shorting or buying puts, those are actions that you take when something is expected to go down. And these ETFs exist for to allow people who just buy stocks in ETFs to participate in activity in the options market and futures market without having to open an options account or a futures account. So a lot of people who don't know how to trade options or futures, but they do know how to trade stocks. So they have created some symbols which kind of mimic the demand for, let's say, the desire to short something, this way, as opposed to the more traditional way, which is more dangerous. That gets into another thing. But the traditional way of shorting, your losses are unlimited, unlimited. So that's a scary thought, that there's no limit to how much you could lose. That's what traditional shorting. With buying one of these symbols, although this chart is extremely ugly, um, you can't lose any more than you've invested. But in the futures market, that's not true. That's not true. You can lose more. Um, um, in a traditional short of a stock or something, you can lose more than your initial investment. So this is a way. But this, to me, let me show this is a long scale. I'll keep it here just for a second. Looks over. Broke it. Okay. And I got a momentum oscillator down here called a MACD. This just shows that there was buying pressure. This upward move just showing that while it was falling, people were buying it. That's all. And I get into details of that in the Patreon. So this sucker has been rising since April, and we saw on the gold chart, gold has been falling. So this is $18. And for you price action traders, they look for the last point where the price died, where the cliff dive started. Price tends to go back to that area. Okay. And so this is 200. Man, if it came up to here, that would be 10. That would be a 1,000%. As we say, 10x. So it's possible. It's possible. But again, people should not buy this. None of these inverse ETFs, bear ETFs, if they're not traders, they don't know. If they don't know how to read charts, if they want something that they can just set and forget, there's no such thing as that with these bear ETFs. These are extremely, extremely risky. They don't always do what what the description says. Okay, all right. So you have to watch it, and you have to know how to read the chart, and when it's not, and notice when it's not doing something um, that's quote unquote logical in terms of being the. It's supposed to be the inverse of the gold mining index, and for reasons like I said that have to do with the demand for uh, puts and say shorts so in the futures market, it might not track that index like our logic thinks that it should. So you'd have to know how to trade, how to read a chart to know when it's not acting right, which would let you get out. Um, but if it works as advertised, this is not bad. This point was February of 2020. So to make 1,000% this low, and that's sweet, or more, or 10,000% if it comes up to this level, and that's not out of the question. If we're talking about a protracted rise in the U.S. dollar and gold destruction, then a 10,000% gain on something like this dog, this horrible looking chart, this dog might have its day. Okay, this dog just might have its day. Okay, I'm gonna take it off out of log scale. But what got my attention was this little high right here when it fell, and this high was 29, 25, 26. We made a higher high, 25.87. Okay, the rule of trends states that downtrends make lower highs and lower lows. Uptrends make higher highs. So this was a higher high. That got my attention. I don't know if it took this out. Oh yeah, it did. 25.15. So this move, this high from last month in July, took us back to this price area, back in time from July of 2020. So it's rolling. And so I'm expecting it to break and start making big moves and jumping up here pretty fast. So this, getting up here to a 180 or 200, I think it's going to get there pretty quickly. You I don't know exactly when that's going to happen, as I said earlier. But just my instincts, nothing scientific by no means. Just my instincts tell me that it's within the realm of probability. Okay, not just possibility, but probability that it could do that by Thanksgiving. Which one? Let's just say the 10x. I really feel good about that, but I don't think it's out of the picture that it could get to that 20x. Oh my god. Oh man. If it hits that 20x, $1,000 would be 100 grand. Wow. But that's what and I got a couple more let's call these lotteries. Let's call those stock lotteries. Let's call them stock lotteries. Okay. I got a couple more of these stock lotteries that you should discuss with your financial advisor. Okay. That you should discuss with your financial advisor, and they can guide you. They know your level of risk, and they can tell you if this makes sense. Um, you know, but just for me, I'm just sharing the way I'm looking at it. This is better than a lottery ticket. This is your chance of winning. This is better than any lottery you've ever played, in my opinion. And even $100, if you 10x, there's nothing wrong with going from $100 to 1,000, or from $100 to 10 grand if this thing does a 10,000%. So that would make anyone feel better. And if their retirement account is getting destroyed because they decided to hodl, they decided to do nothing. Um, if they, made a little change on this little lottery play, because gold tanked, I think that's a feel good move, you know. But I'm gonna see who's riding with me in the chat. But if you like, any of what I said, if I broke it down in a way that kind of made it make sense to you, then consider joining my Patreon, and I'll go deeper and show you really what these squiggles mean, and steer a whole lot of good information your way. You know, you see who I got unreasonable. Oh, see, I've been into my world. Unreasonable man been just got chatting along. Oh, what's happening, young Grizzly? What's happening, bro? I gotta catch up on a few of your videos, man. I'm behind. I enjoy your rants, man. You know, the early bird gets the dollar. That's right. Group behavior is definitely a factor in stock price. That's right. We are pack animals. You know. All right. Human behavior has been the same for thousands of years. That's right. That's right. It's like I teach it this way. If this if you're in a room in a club and everybody starts running to the exit, what you gonna do? You gonna run to the exit. We don't know why. Uh, we're not gonna risk trying to find out why. Just run. Why? Because everybody else running. That's it. We find out later. That in a nutshell is technical analysis. That in a nutshell is what technical analysis boils down to. Is learning to study the herd. Okay. And we're not just looking at the price, we're looking at the momentum, you know, that too. So you can see trend exhaustion. You can see trend forming, trend exhaustion, and trend being exhausted. And there's signs of that. And we look for those signs, and we try to get in just after the trend started, and we try to get out just before the trend ends, or maybe a little, or just after it stops, but there's a point when there's a Elliott wave theory gives us some guidance on about with regard to how much gain you should expect based on this particular pattern that price does. And when we get to like say the fourth quarter, the ninth inning, the final part of the phase, we all know that. You can check my channel with respect to Bitcoin. I put the videos and we talk about it all the time in the Patreon. So we know when those ends are near. So we might be a little bit off here and there, but eventually it's not like, a long time in the future. We might be a week off or something, Um, eventually it will roll over, because all those signs we're looking at is directly related to the price itself, and the momentum and the volume and stuff. So you can see the prices go up, down, and sideways. So you can see deceleration. It doesn't take a rocket scientist to say, okay, it seems that the path of least resistance here is down. Maybe I should protect what I've gained and go sit down. So that's really what it comes down to. All right. I'm just gonna scroll through what Unreasonable Man and Brother Grizzly talk about. They got their thing going. What's happening, Carl McFarlane? Oh, what have you missed, man? Carl McFarlane. I've just been ranting about all this other stuff, and I thought this really should have just been a 10-minute video, but the spirit moved me. Go, just if you got time, you got some other project you working on, just throw this on in the background and get with the way I break down the whole deal with the dollar and the interest rate, the growth cycle, the credit cycle, and all of that, trying to tie it together as the longest intro on earth to talking about the dollar chart and the gold chart. But that's all. That's all. I'm gonna shut this down, and then I'm gonna come back. I'm going to be shorter on the next one. I don't know whether it's going which I'm gonna do first, the S&P or the Ethereum slash Bitcoin. You know, so but check them both out. I'm out, y'all. Thanks for riding with me. Peace. Oh, and post this on your social media, y'all. Help a brother out. I've been on these YouTube streets trying to get to 1,000 man for a long time, but this is a hard sell. I mean, I'm in the manosphere on hearing and all the other talk that we talk about, but it's hard to get people to be as serious about money, and I don't get it. We know that money is a very important piece in that game that we talk about in the manosphere. You know that, right? But people, I guess people think that money is their job, and that's the I'll say that's the red pill wake up call that a lot of Young Grizzly, a lot of your peers, man, a lot of your IT folk, you over here, you get it. IT is rolling. He's making the bag, okay, in his field. He's killing the game in his field. But he's still over here getting this game about how the macro works. Cause the macro has its way with the micro. It takes a while for the micro to affect the macro. It does, but the macro be winning, y'all. The macro be winning. It's hard to fight the macro. It really, really is. And the macro will affect what's going on, in your job. That downsizing is real. And I'm telling you, the logical arguments don't work. Of what I'm doing is so important, and they're not gonna downsize. Listen, if you 30 years old, you haven't seen anything like this. You haven't been here. If you were not an adult working between 2007 and 2009, then nothing you've experienced in your life has prepared you for this. And so listen to those of us with the gray hair that's 60 and up. We're telling you that this is real, and that it doesn't matter how important your field is. It's when the bean counters look at it, they just know, look, we got to cut some people. Doesn't matter about how important this is. We have this debt on the books. We got to cut people. Okay, that project we were working on, that's a great idea. Shelve it for 2 years. We'll hire them back, maybe, or someone that looks just like them. And if we need people over the next 2 years, we're going to increase our number of temporary workers. We're going to start farming more of this work out, and we're going to try to keep our key people. We're going to try to keep as many of our key people as possible. That's what you get ready to hear. And it does not matter about how important it is. I got into an argument with somebody arguing about blockchain, and how things in that like blockchain development and those types of things, that it doesn't matter when this axe swings. I mean, critical projects will get it will get shelved. And so you got to protect your money. You got to protect your money, because that's, at the end of the day, that's what we go to these jobs for, to get the money. Get the money. Okay. And at the end of the day, it's to protect the bag. Okay. Protect the bag. All right. Peace.